Wall Street's truce with Washington shatters. What's next? Shockwaves are rippling through Wall Street, and the calm that once felt unbreakable has suddenly cracked wide open. For most of this year, traders and analysts seemed almost untouchable. They shrugged at President Donald Trump's escalating trade war, dismissed the Federal Reserve's promise to keep interest rates elevated for longer, and leaned on the idea that a surprisingly sturdy US economy would continue to lift stock prices. In short, the street believed it could have its cake and eat it too. But here's where it gets controversial. That confidence is now wobbling. Fresh data showed lackluster job creation, an early warning sign that the labour market's momentum may be cooling. At nearly the same moment, the White House lobbed another round of tariffs at key trading partners, jolting investor sentiment. Suddenly, the twin pillars that held markets aloft, solid employment growth and faith in sound policy, appear far less secure. Why does this matter? When job growth slows, businesses hire fewer workers. Consumer spending can taper off, and corporate earnings projections start to look shaky. Sprinkle in new tariffs, and you add cost pressures for manufacturers and retailers that rely on global supply chains. Imagine a mid-sized factory in Ohio forced to pay more for imported machinery. That expense gets passed on as higher prices or thinner profit margins. Neither choice thrills shareholders. The mounting anxiety has landed squarely on Fed Chair Jerome Powell's desk. Investors are now betting he'll have to trim rates sooner than planned to cushion any economic slowdown. Yet Powell must weigh that against inflation that, while easing, still hovers above the Fed's comfort zone. Cut too early and he risks reigniting price spikes. Wait too long and the economy could stall. It's a classic monetary policy dilemma, and this is the part most people miss. The Fed's mandate forces it to balance jobs and inflation simultaneously, not chase the stock market's every whim. Meanwhile, the administration's protectionist strategy is drawing fresh fire. Supporters say tough tariffs are a necessary bargaining chip to bring trading partners back to the negotiating table. Critics argue the measures act like a hidden tax on American businesses and consumers, undermining the very growth they're meant to protect. The sharp divergence in those viewpoints is exactly why this story matters far beyond Wall Street's trading floors. Bold flashpoint. Should Washington double down on tariffs even if it rattles markets? Or is it time for a strategic retreat? Expect heated debate. So, what happens next? If the labour market continues to soften, pressure on Powell to cut rates will intensify, perhaps leading to a rare policy pivot. On the other hand, if tariffs spark modest inflation without crippling growth, the Fed might keep its higher-for-longer stance, leaving investors in limbo. Question for you. Do you believe the Federal Reserve should slash rates now to calm markets, or would that simply pour fuel on an inflationary fire? Are the new tariffs a savvy negotiation tool, or an unnecessary self-inflicted wound? Speak up, agree or disagree in the comments. Your perspective could be the missing piece in this rapidly unfolding debate. Stock market today. Jobs report, Trump tariffs, Apple, Amazon earnings. 5 things to know Friday. Friday's market open is set against a whirlwind of developments that could reshape investor sentiment. And it all starts with a question. Will a new wave of US tariffs ignite a full-blown trade firestorm or force fresh negotiations ahead? But here's where it gets controversial. Some say these duties punish unfair trade, while others warn they risk hurting consumers and global growth. 1. When the tariffs land, traders are bracing as reciprocal US tariffs kick in, covering dozens of countries with new levies from 10 to 41%. In plain language, that means certain imported goods just got significantly more expensive. President Trump signed an executive order repricing these duties on everything from electronics components to consumer products, aiming to pressure trading partners into more favorable deals. He told NBC News he remains open to last-minute proposals, but cautioned that it's too late to avoid next week's tariffs, though he left the door open for a breakthrough deal in the coming weeks. Reminder for beginners, a tariff is essentially a tax on imports. When it jumps, manufacturing costs rise, companies may pass those extra cents to shoppers, and global trade flows can be disrupted. 2. Could July's job gains fizzle? All eyes turn to Friday at 8:30 a.m. Eastern when the Labour Department releases its July jobs report. Wall Street's consensus forecast is for just a 100,000 increase in non-farm payrolls, the smallest monthly rise since October 2024. For context, June saw 147,000 new jobs, and the economy averaged 130,000 hires per month in the first half of the year. If the slowdown materializes, it might signal cooling wage pressures. Yet even a weak report may not sway the Federal Reserve immediately. The Fed held its benchmark interest rate steady this week, saying it's in no rush to pivot until inflation clearly trends toward its 2% target. 3. Dating a chatbot. Strange but true. Imagine finding companionship not in another person, but in an app. That's reality for some Americans who have formed emotional bonds with AI programs. Everything from casual friendships to full-blown romances. One young professional told CNBC she spends hours chatting with her AI partner, noting it never criticizes her and always responds with care. But the emergence of these relationships shines a light on America's loneliness epidemic and raises thorny questions. Are these bonds healthy? Who is responsible if an AI gives harmful advice? And what about data privacy when your deepest feelings are shared with an algorithm? This is the part most people miss. It's not just about novelty. It's about redefining intimacy in a digital age. 4. Big Tech's latest earnings revealed. Investors are digesting quarterly reports from tech giants. Apple surpassed both profit and revenue expectations, posting its fastest sales growth since late 2021. CEO Tim Cook credited part of that jump to customers stocking up on iPhones and Macs ahead of possible tariffs. Proof that tariff talk can spur buying frenzies. Meanwhile, Amazon's revenue and profits beat forecasts, but its guidance for the upcoming quarter disappointed Wall Street, sending shares lower. And here's where controversy brews. Some analysts argue that big tech's resilience masks deeper challenges, such as antitrust scrutiny and slowing ad spending. How much runway remains for these behemoths? 5. A seat at the tray table for a fee. Southwest Airlines just rolled out assigned seating for the first time. And guess what? You'll pay extra. Instead of free-for-all boarding, the price for your preferred row depends on the route, demand, and even whether you want a window versus a middle seat. For a family of 4, that could mean shelling out hundreds of dollars more on top of ticket fares. Other carriers have raked in billions from similar fees, and Southwest's executives hope this new model will pad the bottom line. But is it fair to charge passengers for something that used to be free? Many customers aren't convinced. Thought-provoking questions for you. What do you think about these new US tariffs? Necessary protection or reckless gamble? Are AI companions a harmless innovation or a troubling trend? And should airlines charge for seat assignments, or is that just nickel and diming loyal flyers? Voice your agreement or disagreement below, and let's get the conversation started. Dow plunges after Trump tariff blitz. BLS shakeup. Stock market breakdown. August the 1st, 2025. Markets in turmoil. When a president fires government officials over economic data, you know things are getting serious. August 1st, 2025 will be remembered as the day Wall Street got a double dose of reality, and it wasn't pretty. But here's where it gets controversial. President Trump's decision to dismiss a top government statistician might signal something far more troubling about how economic data is being politicized. The financial markets took a brutal beating on Friday, with the Dow Jones experiencing its most devastating week since the infamous Liberation Day period back in early April. What triggered this market mayhem? A combination of disappointing employment figures and an aggressive new wave of international trade restrictions that has trading partners scrambling for solutions. Here's what most investors are missing. The real story isn't just about numbers. It's about trust in our economic institutions. Trump's explosive response to jobs data sparks institutional crisis. In an unprecedented move that have economists raising eyebrows worldwide, President Trump announced via social media that he had instructed his administration to terminate Erica McIntosh, the Commissioner of the Bureau of Labor Statistics. His justification? The Bureau's release of what he deemed unsatisfactory employment statistics on Friday. Trump's social media statement declared that McIntosh would be substituted with an individual possessing superior competence and credentials. But here's the controversial part most people miss. He made these claims about data manipulation without providing any supporting evidence, essentially questioning the integrity of one of America's most respected statistical agencies. The employment report that triggered this dramatic response revealed the economy had generated merely 106,000 new positions across the previous 3 months, a figure that fell significantly short of analyst predictions. However, the unemployment rate held steady at 4.2% for July, which actually aligned with expert forecasts. For beginners trying to understand this, when job creation is lower than expected, it typically signals economic weakness, which makes investors nervous about future growth prospects. The tariff tsunami, how new trade barriers are reshaping global commerce. Simultaneously, Trump unveiled a revamped tariff strategy that sent shockwaves through international markets. This isn't your typical trade policy adjustment. We're talking about punishment-level duties that could fundamentally alter global trade relationships. Switzerland found itself facing the harshest treatment, with a staggering 39% tariff rate, a significant escalation from the 31% rate that was merely proposed in April. To put this in perspective for newcomers, a 39% tariff means Swiss goods become nearly 40% more expensive for American consumers, making them much less competitive against domestic alternatives. Taiwan, meanwhile, will contend with a 20% levy on its exports to America. Both nations have indicated their intention to continue diplomatic negotiations with the White House, though the effectiveness of such discussions remains questionable given the administration's aggressive stance. Canada received its own dose of trade medicine, with Trump implementing 35% duties on Canadian products that fail to meet North American trade agreement requirements, effective immediately. Prime Minister Mark Carney expressed his disappointment publicly, yet Canada appears reluctant to engage in retaliatory measures, which raises interesting questions about the country's strategic approach. The president's new tariff framework operates on a sliding scale based on trade balance relationships. Nations maintaining modest trade surpluses with America will face 15% duties, while countries running trade deficits will encounter 10% tariffs. Interestingly, Mexico received a temporary reprieve, with Trump extending current rates for an additional 90 days to allow for potential trade agreement negotiations. Amazon's cloud stumble adds tech sector pressure. As if the political and trade turmoil wasn't enough, Amazon delivered its own market shock by reporting lackluster performance in its cloud computing division. The e-commerce giant's shares plummeted 8.3%, demonstrating how corporate earnings disappointments can amplify broader market concerns. This development is particularly significant because Amazon's cloud services have been a primary growth driver for the company. When a tech titan stumbles in its most promising sector, it often signals broader challenges in the technology landscape that investors need to consider carefully. Multiple corporations throughout the week have issued warnings that tariff uncertainty is creating operational challenges for their businesses, adding another layer of complexity to an already volatile situation. Market carnage. The numbers tell a devastating story. By Friday's closing bell, the financial damage was extensive and widespread. The technology-focused Nasdaq Composite suffered the most severe losses, declining 2.2% and leading the market downturn. The broader SP 500 index dropped 1.6%, while the Dow Jones experienced its most challenging week since the April tariff announcements. For those new to market analysis, these percentage drops might seem modest, but they represent billions of dollars in lost market value and reflect deep investor concern about future economic conditions. Bond markets told their own story of uncertainty. Treasury yields on 10-year government notes fell more than 0.1 of a percentage point, finishing at 4.218%. When bond yields decline, it typically indicates that investors are seeking safer investments, which suggests they're worried about economic growth prospects. The pain wasn't confined to American shores. European markets experienced significant sell-offs, with Italian, French, and German stock indexes all declining more than 2.5%. This widespread international impact demonstrates how interconnected global markets have become and how American policy decisions can trigger worldwide financial reactions. Asian markets joined the decline, with South Korea's Kospi index sliding 3.9% after Seoul announced plans for increased corporate and investor taxation. The WSJ dollar index shed 1.1%, indicating weakening confidence in the American currency. The bigger question: are we witnessing a fundamental shift? Here's what's truly controversial about this situation. Are we watching the politicization of economic data reach a dangerous tipping point? When government officials are fired for producing unfavorable statistics, it raises serious questions about the independence of our economic institutions. Some economists argue that questioning data integrity without evidence undermines public trust in the very foundations of economic policymaking. Others contend that government agencies should be held accountable for their performance and methodology. What do you think? Is Trump's response to disappointing economic data a necessary accountability measure, or does it represent a dangerous precedent that could undermine the credibility of government statistics? Should economic data collection remain completely independent from political influence, even when the numbers paint an unfavorable picture? And this is the part most people miss. The real test of market resilience may not be how it handles individual policy announcements, but how it adapts to an environment where the reliability of fundamental economic data becomes a political football. Share your thoughts. Are these bold moves necessary corrections to failed policies? Or are we witnessing the dangerous erosion of institutional independence that could have long-term consequences for market stability and investor confidence?